Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 369 on April the 4th, 2025. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Iris Energy, Rivian Automotive, and the VanEck Vectors Gold Miners ETF. And we discuss three new trades on Cleanspark Inc, Riot Platforms, and Gamestop. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the markets crashed this week on news of tariffs to nearly every country in the world. The Dow Jones Industrial Average lost 3,269 points, closing at 38,312 points. That's a loss of 7.86% in 1 week. The S&P 500 index lost 506 points, ending the week at 5,074 points. That's a 9.08% loss in 1 week. Now it's time for the topic of the week. The topic of the week is market price discrepancies. Sometimes option markets end up being priced differently due to short-term spikes in volatility and the news. Remember, a spread can only ever be worth the difference between the strike prices. As I was doing research for new trades, I came across Nike, symbol N as in November, K as in kilo, E as in echo. On most of the options, the bid is higher than the ask. That's backwards. That happens when the specialist really wants to buy options instead of selling them. However, you are left with opportunities for a true arbitrage. A true arbitrage is when you lock in a profit without any risk. Right now, the bid on the April 58 call is $2.55. The ask on the April 59 call is 85 cents. That means I can sell the 58.59 call spread at $1.70. We know that a $1 spread can never be worth more than $1. So if I was able to sell the spread at $1.70, then I would be locking in a guaranteed profit of 70 cents. You can see this in the pricing across the board in the month of April, really the April 17th expiration for Nike. Having been a DPM or designated primary market maker, I'm certain you could not execute these trades when the market was open. The moment the market opens on Monday, everything will price out the correct way. You normally don't have a bid higher than an ask. One of the other trades you can do in that scenario is you can sell that very option and then turn around and buy it back for cheaper. Or you can buy it first and sell it for more money than you paid for it. So that's one of the reasons, that's the main reason you would never be able to execute this or never actually be able to do it. Now, the reason I wanted to point this out is because this is a perfect example of finding a true arbitrage in the markets. If you could execute on this, you would do as many of these as you could afford to do just to lock in a riskless profit. If you don't understand what I'm talking about right now, you should definitely email me, reach out to me, and we'll hop on a phone call so that I can explain this to you. It's a very basic concept in markets in general, and it can be true across every market, whether you're talking about stock, options, futures, bonds, convertibles, warrants, any of it. The bid is almost always, I can't even think about a scenario where the bid would be more than the offer in a regular market. Now, the pricing is breaking one of the main fundamentals of option trading. So I also remember being on the floor and making sure that the end of day pricing was going to be beneficial to the other market makers in the pit. If most of the market makers in Nike are long all of these strikes, it would make sense that the overnight price is higher to keep all of those traders from possibly experiencing a margin call with their clearance broker. Stuff like that occasionally happens on the floor, especially after two back-to-back high volatility days like we've seen this past week. There's so many lessons to be learned from the market movement of the past couple of days. If you're a little lost and need some help, feel free to email me. But everyone should be keeping their eyes open because there are some textbook situations that really textbook opportunities that may be opening up due to so much movement and the higher volatility price. Higher prices and higher volatility don't tend to last forever. When I was in the energy markets, we used to say the cure for higher prices is higher prices. In option trading, I would say the cure for higher volatility is higher volatility. So we'll see how this plays out in the next coming weeks. All right, and given how much the market fell, it should not be a surprise that we didn't have 3 winning trades this week. So let's go ahead and get into the trade review of last week's trades. We'll start off with the cover call on Iris Energy, symbol I as in India, R as in Romeo, E as in Echo, N as in November. At the time, the stock was trading for $6.07 per share. I looked at buying stock and selling the April 6.5 call at 38 cents. That could give us a return of 13.34% in 3 weeks. Well, shares of Iris Energy lost 13 cents, ending the week at $5.94 per share. The call option that we sold can be closed for 0 loss at the moment. So our break-even point on this trade is $5.69 per share. The current stock price is still 25 cents above our break-even point, which means we don't really have a reason to make any adjustment on this trade so far. So thankfully, Iris Energy managed to avoid the crash that most of the larger companies experienced this past week. Next up, we have the credit spread on Rivian Automotive, symbol R as in Romeo, I as in India, V as in Victor, N as in November. At the time, the stock was trading for $12.41 per share. I looked at selling the April 12, 11.5 put spread at 17 cents. That could give us a maximum possible loss of 33 cents per spread. Well, shares of Rivian Automotive fell $1.20, ending the week at $11.21 per share. The out-of-the-money put spread that we sold is now in the money, which means this spread has lost the maximum amount of money possible if you were to close the trade out immediately. Now, does that mean that we should panic? Absolutely not. We knew this trade had a limited loss profile when we entered it because this is a spread. That's one of the main reasons I trade spreads. I'm fine turning this trade into an iron condor by selling a call spread against it. You want to select call option strikes that are above the put spread strikes. Now, the problem right now is that the upside calls don't get you much premium. So I would lean towards waiting. There's typically a bit of a dead cat bounce after such a heavy loss that like what we saw over the last few days. So that might lift the stock price in the next 2 weeks, putting the spread back into our profit range. Either way, we have a few more decisions to make before this trade expires. And then our final trade of last week was the debit spread on the VanEck Vectors Gold Miners ETF, symbol G as in Golf, D as in Delta, X as in X-ray. At the time, the stock was trading for $45.58 per share. I looked at buying the April 45 half call spread for 31 cents. That could give us a maximum gain of 19 cents or a 61.29% return in 3 weeks. Well, shares of GDX fell $3.89, ending the week at $41.69 per share. The in-the-money call spread that we bought is now way out of the money. With 2 weeks left on this trade, I'm not going to expect the stock price to suddenly jump back to previous levels. We're currently $3.62 below the break-even point. Thankfully, our loss is capped to the price that we paid for the spread. And in making an adjustment, my first goal is to recoup that money, the 31 cents that we paid. Now, the bid-ask spreads are much wider than normal given the price movement of this past week. I totally understand that. That affects the expected price of the new spreads we'll enter. Now, I'm first looking to turn this debit spread into a credit spread. I'd start by selling the 44-45 half call spread. I then might look to sell a lower strike put spread to create this iron condor. But I'm leaning once again towards waiting a couple of days just to make sure that this market is not still going to be free falling before I sell the put spread. That, of course, will turn the entire trade into an iron condor once I sell the put spread. But I'd definitely wait to see if this free fall has stopped in order to avoid catching a knife on the downside. Now, even though this week ended in a loss, by buying the spread, your maximum loss is $31 per spread. So with the stock, your loss would have been $389 per share per 100 shares. Now, keep that in mind when people tell you how risky options are. If you're trading spreads, if you're even just buying outright options, if you're buying options, your maximum loss is locked in from the moment you enter the trade, right? When you buy stock, your maximum loss is the stock going to zero. It can definitely move quite a bit on you. So because of that, I've always seen options as being far less risky than stock in almost every scenario. That's it for the trade review or the review of last week's trades. All new trades this week are purely educational. The volatility is super high right now in the market, and there's a lot of risk and, of course, opportunity in the market. So only risk capital you are comfortable losing. These periods don't typically last too long, and there will be more trading opportunities in the future. So you don't have to chase this volatility if you don't want to. Now, the trades mentioned on today's show will use the April 17th expiration for monthly options in April. There's only 2 weeks left before expiration. The shorter time frame leaves us with very little time to make an adjustment. Hence, the risk is higher due to that as well. So let's go ahead and dive into these trades. Like I said, this is mostly just informational this week. I would be very cautious in putting on any trades right now due to the extra volatility in the market. As long as you understand the risk, have fun, go after it. I'm doing the same thing, but I'm also aware that this volume or the speed of price movement can really scare some people and help people get banged up if they're not used to it. So we're going to start off with the cover call on Cleanspark Inc. Symbol C as in Charlie, L as in Lima, S as in Sierra, K as in Kilo. The stock ended the week at $7.32 per share. I'm looking at buying that stock and selling the April 7.5 call at 52 cents, hoping for a return of 9.56% in 2 weeks. Now you enter this trade by buying stock for $7.32 and selling the April 7.5 call at 52 cents. This trade makes the most money if stock prices finish or expire above $7.50 per share. The break-even price on this trade is $6.80 per share. In real terms, the stock purchase would require $732 and you would collect $52 for selling the option. Next up, we have a credit spread on Riot Platforms. Symbol R as in Romeo, I as in India, O as in Oscar, T as in Tango. The stock ended the week at $7.14 per share. I'm looking at selling the April 7 6.5 put spread at 15 cents. That could give us a maximum possible loss of 35 cents per spread. Now you enter this trade by selling the April 7 put at 48 cents and concurrently buying the April 6.5 put for 33 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $7 per share. The break-even price is $6.85 per share. In real terms, you would receive $15 per spread that you sell and have $35 at risk. And our final trade on today's show is a debit spread on Gamestop, symbol G as in Golf, M as in Mike, E as in Echo. The stock ended the week at $23.46 per share. I'm looking at buying the April 22.5-23 call spread for 36 cents, hoping for a maximum gain of 14 cents, or that would be a 38.39% return in 2 weeks. Now you enter this trade by buying the April 22.5 call for $2.26 and concurrently selling the April 23 call at $1.90. This is a debit spread because we're selling the spread, and this trade makes the most money if stock prices expire above $23 per share. The break-even price on this trade is $22.86 per share. In real terms, you'll pay $36 to enter the spread, and your maximum gain is $14 per spread. So that's it for today's show. Thank you guys so much for following, for listening, and for the feedback. I get great email from you guys. I even get an occasional correction when I make a mistake on the show. I appreciate it. It just lets me know that you guys are listening and following along, which makes my heart happy. So have a wonderful weekend, and as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.